Hi, and welcome to the Day Trading for Beginners podcast. This is season 2, episode 10. And in this episode, we're going to talk about some trading rules that I'm following, some common mistakes that I have already made. And I want to emphasize this idea that the hardest part is sticking to your strategy. So I want to start with talking about rules and mistakes a little bit, and then I'm going to tell a little bit of a story about my trading experience that I had on Halloween when the market was down. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader, and I am studying some strategies in this season. So if you're a pure beginner, you can find the link to my 6-month blueprint where I outline everything that I've done in the first 6 months. And then every other resource that I'm using for strategy and tools, you can find in the show notes below. So trading rules are essential, but sticking to them, I think, is where many traders will struggle. And I think other texts and books and, influencers have certainly said this as well. Beginners, often find themselves chasing prices, leading to poor decisions that can sort of spiral into bigger losses. So emotional trading, like, doubling down after losses or reacting impulsively to market volatility, it's something many think that they can avoid until they experience it firsthand. And this is why it's crucial to start small or with paper trading. It's something that I've been recommending this whole journey, where mistakes have, minimal impact. You can still experience it. You can still experience them, but you're not going to lose your whole portfolio. Keeping your rules visible and ingrained in your routine can reinforce discipline and help avoid common pitfalls. And this is extremely important. When you say a rule, it's very easy to not follow it. You need to really, really experience it and focus on it and hammer it home. Mindset and control are just as important, sometimes even more important than technical skills when it comes to trading. But I think that idea is a little bit abstract. It's easier to think, I'm going to learn and master these technical tools rather than, I'm going to focus on my mindset and not trade emotionally. I think it's easier to think that learning more, getting better at technical skills can help you trade better, where in fact it's probably more important to have a mindset, but it's sort of something that you sort of need to experience, in my opinion. So the hardest part, I think, is actually sticking to your strategy. There's so many strategies out there, but what's going to separate winners from losers are the people that can actually stay disciplined and stick to your strategy like a machine. So personally, after paper trading for some time now, I can certainly see how easy it is to make some common mistakes. And these would be amplified if I was using real money. So, there are many, many good strategies out there, but it seems that sticking to this strategy is probably the hardest thing to do. And again, it's what separates winners from losers. I can say that based on my own experience. And I've come across this idea recently in a book called The Best Loser Wins, and various other resources that I've sort of touched on over, the last several months of this journey. Sticking to your strategy is really, really hard. So here are the rules that I've personally been following with the market symmetry strategy that I've talked about in the last few episodes. So the first rule is really stick to your strategy. So the hardest thing to do is just stick to it, especially when you're trading real money eventually. Rule 2 for this strategy is never ever chase price. Only buy at support. Never chase price. Let price come to you and do not overtrade. So there are so many opportunities out there. You really need to avoid the fear of missing out, avoid FOMO, and never chase price. Only buy at support. That is easier said than done. Limit position size. So allocate a maximum of 10% of your portfolio per position, and then enter positions with 1% when they are volatile or your conviction is not very, very high. So that's number 3. Number 4, buy at support, sell at resistance. So avoid buying in ranges. Wait for clear support or resistance. When price is in a range, the volatility can work against you. It can either go up or it can go down, and you sort of have less control. Whereas if you're only buying at support and you have good conviction that that is support will hold, there's a better probability that the trade is going to go your way. And then the other rule is stay uncomfortable. Be prepared to buy when price feels low or difficult. It can be uncomfortable to buy at these support levels. It's always more comfortable to buy at all-time high. So those are the 5 main rules. Stick to the strategy, never chase, limit your position size, buy at support, sell at resistance, and stay uncomfortable. Now, these seem pretty easy to follow, but they are not. I've personally experienced FOMO, overtrading, emotional reactions recently, and I can see how easy it is for people to lose money trading. So on Thursday, on Halloween, October 31st, I was buying coin at support levels, and the market had a big down day that day. Coin had its earnings released on the day before, on the Wednesday, and coin was dropping and it kept falling through every support level. And, with this strategy, you buy at support, but if there's support levels below, you want to dollar cost average into those. And I have ended up allocating much more than 10% to this position because I kept wanting to buy lower to dollar cost average and bring my cost of the stock down. And I veered off these trading rules. I allocated too much. I had fear of not buying at the bottom and having these positions with a high cost that, might not turn green for many, many weeks or potentially longer. So these mistakes are very, very easy to do. And I know they would be amplified if I was trading with real money. And again, now I have a large position of my portfolio in my paper trading account sort of stuck with a high cost of a stock that might not recover for some time. So bottom line, you need to stick to your strategy and you stay disciplined. If I stuck to my strategy, I should have been more patient. I should have watched price instead of immediately buying on the bell when it, started going to a support level. I could have waited all day for the price to drop to support levels, or I should have just allocated a much smaller amount knowing that there were more support levels there. Instead, I was chasing and I was hoping to buy at the last support level, which I was hoping to be the bottom. So, practicing with the paper trading account allows me to experience these mistakes and feel them, but without risking any real money, where I potentially would have been wiped out, or I would have had a large portion of my portfolio in this position where I couldn't trade it. And I might have got really emotional and sold it at a loss. So very, very easy to do. And again, these rules that you have that I knew certainly flew out the window when, I'm sitting in front of my computer and I'm watching a stock fall. It's very easy to click the mouse, buy, and kind of lose focus on your strategy until you experience things like I experienced. So you really got to practice, and you have to, kind of experience these mistakes, because again, when you say them, they just don't sink in until you kind of actually go ahead and do them. So there's many common mistakes that you will want to potentially avoid. And again, encountering them potentially when you're paper trading is a great thing to do. Even when you transition to real money, hopefully you experience these and they don't do too much damage to your account. I can totally see how, people will need to experience some type of loss for things to really sink in. So I'm going to go over what I think are some common mistakes and I've experienced myself and that I've researched around that you will want to be aware of and hopefully, again, experience in a paper trading account, as opposed to, when you're actually trading real money. So the first one is FOMO. It's fear of missing out. When you see other traders or the market making gains, that can create pressure for you to jump into trades. So with the strategy that I'm using, you're only supposed to buy at support. If you come across a chart that has a breakout and you wish you were in that breakout, you cannot buy that breakout. You need to understand there are so many more opportunities, and that just wasn't one you were able to do. But when you do jump in, you chase trades, you're going to enter at potentially suboptimal times, often higher prices that are planned, and it's just not a good thing. FOMO is huge. Many people buy all-time highs instead of buying at lower support. levels: impatience and overtrading. So, new traders like me, traders like you, you're going to feel the need to constantly be in the market, thinking that you're going to miss out on opportunities. And this was me with that coin position. I didn't want to lose out on not getting back in at a lower position. And I overtraded and I kept trying to find the bottom. And that's going to lead to lower quality setups. It's going to lead to more risk. More of my portfolio was now involved with this trade. And it's not your strategy, and it's not something that is going to be beneficial in the long time. You might get lucky where, you put everything on the support and it finally turns and, the market goes back in your favor. But over the long run, that will not work. You're going to lose your money over trading and being impatient. Lack of confidence in a strategy. So, if you're not fully trusted in your strategy, especially if it requires waiting for specific setups, then you're going to have doubts. You're going to abandon your strategy. You're going to start experimenting and so on. So you really need to stay disciplined, trust your strategy, and just just become a machine and just stay focused on what you're supposed to do, what your strategy tells you to do. It seems simple, but it's really, really hard. Again, chasing price moves, the urge to buy when prices are climbing and you want to catch up to the market, something you really, really want to avoid. And then emotional reactions to losses. So, I bought and the stock went down, and I put in another order. The stock went down. I got emotional, and, I wanted to really, clear that loss with buying heavier and lower positions, and it just was not working. So losses can lead to frustration, fear, causing us to make impulsive changes to your strategy. And when you're sitting in front of your computer and you're trading and you're getting emotional like this, trust me that you will not be able to do the right thing if you don't have experience doing this before. You think you're not going to trade, and the gambler in you was just going to set your whole portfolio on a buy, and you're going to watch your portfolio and your money just evaporate. So it's really, really important to experience this, because, when you're emotionally trading, some of us just can't control yourself, and you're going to make really, really bad decisions. Failure to take profits or cut losses. So that's another big mistake. If your position and your strategy tells you to get out when, the position turns on you, you have to absolutely get out. And then when you're supposed to take profits, depending on what strategy you are using, then you really need to take those profits. Trying to win back losses, it's sort of called revenge trading. So a lot of people do that, and I sort of experienced that with what happened with me. You buy and it drops, and you want to buy lower to regain all your stock. But just know that if price is falling, it can always go lower. And then trading too large too often is also a common mistake. A lot of us beginners think that we want big wins. We want to we think a stock's going to go up by 10%. So we want to put our, a large portion of our portfolio, whereas you really want to make smaller wins consistently over time, rather than, try and win big, trade too large too often. That's just not going to work out for you. Confirmation bias. So, if you look for signals that confirm your beliefs on a position, rather than really looking what the price action is doing, that's going to cause you to make mistakes. And again, with the whole trading too large and too often, underestimating the value of small wins. So, beginners may think that you need to, again, trade large, quick gains to be successful. Whereas, incremental profits are better. Missing out on small but consistent gains can result in much more riskier trades that over time will not work out for you. So those are some common mistakes that I've already experienced paper trading, that I've researched, and I can just imagine that some of them are going to really wipe some beginners out. And again, your rules, whatever strategy you're focused on, you really need to know your rules and do your best to stick with them. And the best thing that you can do is just get out there and actually paper trade. Find a strategy and test it out and see that, and try your best to not make these mistakes. Try your best to follow all your rules to a T. I think that is really, really what's going to separate you from being a successful trader versus not, is just being able to stick to your strategy. So I hope that you found this useful. In the show notes below, I've got a link to some of the modules that go over this that are in our school group. It's a group where beginner day traders are coming and sharing their journey and following along with some of this content. So you can find links to that below this video. I hope that you did find this useful. And again, in the next few episodes, I'm going to just share more of my experience with some of the trading strategies that I'm learning. And I'm hoping that you can maybe come and join us in our school group and share some of the things that you're learning with your journey as well. So thanks so much for listening. I hope that you found this useful. Go out there, fail in your paper trading account, make some mistakes, experience emotional trading, and do it with paper money so you don't lose real money. And again, I wish you the best, and I will talk to you in the next episode.